What if I told you that one political decision on the other side of the world could quietly shake your portfolio, even if you never invest outside America? Because right now, something is happening inside Japan that most mainstream headlines are barely explaining. And yet global money managers, hedge funds, and institutional investors are watching it very closely. This isn't just about politics. It's not just about interest rates. And it's definitely not just about one country's economy. This is about the hidden plumbing of the global financial system and how a shift in Japan could ripple straight into stocks, bonds, real estate, and borrowing costs inside the United States. Today, I'm going to break down exactly what changed, why markets reacted immediately, how a decades-old financial strategy is now under threat, and what smart investors should be watching before the crowd catches on. Because once global liquidity shifts, prices don't ask for permission. They move fast. Let's start with what actually happened. Japan just entered a new political phase after a decisive election, result that gave leadership strong authority to push policy quickly. And when markets see political power combined with economic stimulus promises, they immediately start asking one question: how will this be funded? Because stimulus, tax cuts, defense spending, and economic support all require money. And in a country that already carries enormous debt levels, funding becomes the central issue very quickly. Markets don't react to speeches. They react to financing pressure. And that reaction showed up almost immediately in Japanese government bond yields. Interest rates surged to levels not seen in decades. Now, if you're an American investor, that might not sound dramatic. After all, rates in the US are much higher. But context is everything. For years, actually, for decades, Japan operated in a world of ultra-low interest rates, near zero, sometimes even negative. Cheap borrowing wasn't temporary. It was structural, and that cheap money didn't stay inside Japan. It spread across the entire global financial system. This brings us to one of the most important forces in modern finance, something most retail investors never hear about: the carry trade. Let's simplify it. Imagine someone lends you money at almost zero interest, practically free. You take that money and invest it somewhere that pays you 4%, 5%, maybe more. You keep the difference. That's the basic idea. For decades, global investors borrowed cheaply in Japanese yen, then invested that money into higher return assets around the world: US Treasury bonds, American stocks, corporate credit, real estate, anything with yield. And because borrowing costs were so low, institutions didn't do this cautiously. They did it with leverage. Massive scale. Japan effectively became one of the world's primary funding sources for global investment. Cheap yen fueled expensive assets. But here's the critical point. Carry trades only work when borrowing stays cheap. If funding costs rise, profits shrink. If funding costs rise fast, positions get unwound. And unwinding leverage is never gentle. When borrowing in yen becomes more expensive, investors who funded global investments with Japanese money face pressure. To exit those positions, they must reverse the there's another powerful lever, one that's even less visible to the public: foreign exchange reserves. Japan holds enormous reserves of international assets. Think of it as a financial war chest used for stability, currency defense, and economic management. A significant portion of those reserves is invested in dollar-denominated assets, including US government bonds. Now think about the political environment again. If leadership wants to stimulate the economy, cut taxes, increase spending, support growth, funding must come from somewhere. Borrow more, or use existing capital. If reserves are tapped, foreign assets may be sold. And if US treasuries are sold in large volume, bond prices fall. When bond prices fall, yields rise. And when US yields rise, borrowing becomes more expensive across the entire American economy. Mortgages, car loans, corporate financing, government debt servicing. Higher yields tighten financial conditions everywhere. So now you have two potential forces operating at the same time. Carry trades unwinding, creating selling pressure in risk assets. Reserve adjustments, pushing global borrowing costs higher. That combination is powerful, and markets understand this. That's why professionals don't react to elections emotionally. They react mathematically. Bond math, currency math, liquidity math. Institutional investors analyze how capital flows shift, how leverage behaves, and where pressure points emerge. Because modern markets are not just driven by growth. They're driven by financing conditions. And financing conditions are changing. Now let's zoom out. When one major economy transitions away from ultra-cheap money, global liquidity gets repriced. Leverage that looked safe suddenly becomes fragile. Assets priced for easy financing must adjust. Businesses dependent on refinancing cheap debt become vulnerable. Highly valued growth stocks, priced on future expectations, face pressure when discount rates rise. Meanwhile, durable companies with strong cash flow and low debt become more attractive. This is not random volatility. It's structural adjustment. But political alignment doesn't eliminate financial consequences. Domestic economic policy inside Japan can still reshape global capital flows. Regardless of diplomatic relationships, markets and geopolitics move together, but not always in the same direction. There's also the role of monetary policy. The Bank of Japan spent years maintaining extraordinary accommodation, controlling yields, stabilizing markets, and keeping borrowing costs extremely low. If that era is ending, even gradually, global investors must adjust to a world where funding is no longer essentially free. And global leverage is extremely sensitive to funding cost. When money is cheap, leverage expands. When money becomes expensive, leverage contracts. That contraction can move markets quickly. So what should investors actually do with all this information? This is not about predicting a crash tomorrow. It's about recognizing structural pressure building beneath the surface. Second, follow signals that matter. Japanese bond yields, currency strength, policy direction, global rate volatility. These indicators reveal capital flow changes before headlines do. Third, evaluate exposure to cheap money dependency. Assets that require low rates to justify their valuation are the most sensitive to liquidity tightening, highly leveraged businesses, speculative growth sectors, refinancing-dependent industries. These areas feel pressure first. Meanwhile, assets with real earnings power, strong balance sheets, and pricing control tend to hold up better. There's also a long-term pattern worth remembering. When global economies respond to slowing growth or rising stress, governments often expand balance sheets. Liquidity increases. Currencies fluctuate. Volatility rises. Historically, environments like that reward tangible value and financial resilience and punish fragility. Built on leverage, let's connect everything into one clear chain. Political change introduces stimulus expectations. Stimulus raises funding questions. Funding pressure lifts bond yields. Higher yields threaten global carry trades. Carry trade